Today, I want to talk to you about why you need to get out of cash. And what I mean by this is if you're holding a lot of cash or cash-like positions, you should probably be finding a way to get out of it. Why? Inflation. I'm going to go into today what inflation is, what's expected to happen with inflation, and where you can park your money instead to protect yourself against inflation and put yourself in a better financial position. That's it. That's going to be the brunt of this video. So thanks for tuning in. Let's get into it. What is inflation? Inflation is going to be how much the cost of something today is going to go up over the next year and what it's going to cost you tomorrow. Typically, it's measured in a percentage and an annual percentage. And what that means for you is anything that you're currently buying today, whether it's your coffee or you're going out to get a meal, or your iPhone, no matter what it is, the same product next year will cost you more money. Now, typically the Federal Reserve targets a 2% inflation amount. It's not always the case. It's not a perfect world, but that's what they target. They've talked about raising it to 4%. We're in a really weird financial time, and moving to 4% inflation is gonna be a great reason for you to start getting out of cash positions and stop with the savings accounts and get into assets that are going to help you get financially free. The reason for this is your cash, that $100 that could have bought you something today will only buy you, say, $96, $97 worth of stuff next year. Whereas if you park into an asset, whether it's a home or stocks, gold, cryptocurrency, any of that good stuff, they typically will protect you against inflation, as even though you're not necessarily going to have your $100 guaranteed to turn into more than $100 in those investments, and there is some risk associated with them, the good thing is if they're $100 today, they're probably going to be worth $100 next year still, because the inflation amount will go up. They'll carry with inflation essentially. So you'll be protecting yourself in that method, and I'm going to break down each of those asset classes and how they're going to work for you in an inflationary market. Although I may seem biased in making this recommendation as a real estate agent, I believe the best place to park your money right now with inflation flying up is going to be in real estate. Now, taking my real estate agent mindset out of it and just thinking about it from a typical perspective, when you get into real estate, you are leveraged typically, unless you're paying cash for the entire thing, which means what you're owning, although the house can go up in value after you close, you'll get the entire increase in value on that amount. So let's say you put 5% down to get into a house. Although you only own 5% of the house, when the house goes up $10,000 over the next year, you get all $10,000 in gain. Whereas in other investments, if you're taking a shot in the dark and going in with that same 5% nominal amount, you're only gonna get a proportionate gain to the 5% you put down. So let's say, in order to make it simple, changing from percents or not, let's say you put $10,000 into a house to get in, and then the house goes up $10,000. You don't just get $500 as the 5% that you put down, you get all $10,000 of that gain, even though the bank still owns 95% of the house. You're still winning on that end. Whereas if you put $10,000 in stocks and there's a $500 gain in your position relative, then you're getting the $500. So the leverage, it can work both ways, but typically with the way the housing market works over time, you're going to benefit positively from this leverage as long as you're being smart. In your other financial areas, you're not going to have to worry about leverage as much. But on top of all that, the reason that I'm going to recommend getting into real estate in an inflationary market is the debt. So because you're taking a loan out for a certain nominal amount, so let's say your loan amount is $300,000. That $300,000 that you borrowed, you're having the bank take that position and lock into $300,000 today. this time next year, $300,000 is not worth as much as $300,000 is today. So you're basically having the bank pay for your inflation. And although you're going to have an interest rate on the loan, the interest rates right now are incredibly low, 2.5%, 3%, insanely low numbers. So with the interest rate being lower than the expected inflation, the bank is pretty much paying to carry this loan, so to speak. And you're putting them in this position and taking a huge borrowing advantage moving forward. So with the fact that you can leverage debt like you never have before, and the fact that houses will likely increase in an inflationary period as well, the prices and values, great place to park any money that you have right now to protect yourself from inflation. Let's talk about stocks for a second in an inflationary market. Again, anything's going to be better than staying in cash, which is just guaranteed to deteriorate. When you get involved in stocks, whether you're going in an individual company, which is going to be a little riskier, or if you're getting into a general index, that's going to be a little more diverse and just prove to be a little bit less risky as an asset class, the value of the products is going to stay the same for these companies, but their earnings, their revenues, and just their overall market cap is going to tend to inflate with inflation. The prices of their goods are going up, so if they make the same sales next year as they do this year, it's going to look like they made a whole lot more money. Now, although that doesn't make them any better of a company or not, what it does mean is at the least, if they do the same things they've been doing, they're going to be worth the same thing in today's dollars as they are in future dollars. And that's good for you relative to where cash is going to deteriorate. So stocks are definitely a good place to get into. I would tend to recommend, if you're not too sure on what you're getting into, to just go with something simple like index fund or mutual fund, ETFs, something that is more diversified. But stocks are definitely a better place to get into than cash at the moment. At this point, if you've been seeing any of my videos, you are probably familiar with stocks and real estate, but I want to talk about something a little less mainstream today, and that's gold. Especially for us millennials, we're not typically as interested in commodities, but with gold, you're going to take out a lot of the risk that comes with picking whether it's individual stocks or the housing market in terms of a holding period. Sometimes with the stock market or housing, you may have to hold on for a little bit longer than you anticipated in order to see the value go up the way you would like it to. But although gold is exposed to the same type of risk, it tends to perform a little better and be a little less volatile. And it should ratchet up with inflation. The cost of gold per ounce should ratchet up with the price of inflation. Now, if you're anything like me and you just have never really had that much of an interest in gold and you're wondering how to get into it, there are ETFs for that. So you can buy gold sort of like how you buy stocks. There's companies that you can either get into gold mining companies, or you can just get into general ETFs that take positions in gold and mirror pretty closely the price of gold in terms of how the ETF is performing. I'm going to put a link in the description for some of the ticker symbols that you might want to look at if you're interested in getting into gold. Now, another interesting thing that I've heard recently is that cryptocurrency is the millennials version of gold. I don't necessarily agree with this. I don't view cryptocurrency the same way that I view gold or other precious metals, but some people, and if you are a little more confident and have done your research in this market, some people might like to get into cryptocurrency as a place to park instead of cash. And I'm totally fine with that. If you've done your research, go for it. But to close out today, I would say that real estate is the best place to get into with your money right now as opposed to sitting in cash. And that's because of the fact that you can kind of pin the debt on the lender and have them get hit harder by inflation than you are yourself. The leverage allows you to grow a little bit faster than you may elsewhere. And if your financial picture is pretty sound outside of the leveraged investment there, you should be totally fine to make out the best in real estate right now. Stocks are not a bad place to go at all. Definitely a better choice than sitting in cash. Gold is the least risky of the three, I'd say. And if you're willing to get into cryptocurrency, go for it. But any of those four places, I would recommend over sitting in a heavy cash position. So I hope that helps you guys out. I appreciate you checking out my video today. I highly encourage you to get out of cash. I hope I made that clear. If you have any questions on how to get into some of these items, I'm gonna put links in the description below. But typically for getting into real estate, I recommend contacting a good realtor. Hey, right here, I'll help you out. If you're trying to get into stocks, I recommend just using user-friendly platform Robinhood. There are definitely others, you can go with your choice, but try not to go anywhere that has commissions paid on trades. And the market's super competitive and you don't need to be paying commissions. Gold, I'll put a link in the description to some tickers that may be good to trade for getting into precious metal. And crypto, I'm gonna stay out of. But there you have it, guys. Now you have some items to take action on. And if you get any questions or just want to discuss inflation, I always like chatting about this kind of stuff. So reach out to me and I'll see you guys again in the next video.